Hello everyone. So today we will begin and continue with our session on depreciation. So before going to methods of depreciation, let's understand what are the factors for calculating depreciation. Okay, so as explained earlier, depreciation is an estimation. So it's not very easy to estimate the depreciation. So there are some factors which have to be taken into consideration while charging or calculating the depreciation. Okay, the first factor is cost of asset. Okay, now cost of asset includes the cost price of asset plus all expenses till asset is ready to use. Okay, means all the expenses which are incurred till the asset is ready to use is also included in the cost of asset. Okay, what are those expenses? Installation charges. Okay, there may also be some transportation charges. Correct. Then there may be some commissioning, then there may be some trial runs. Okay, so cost of trial run, all these expenses plus the cost price of the asset will make the cost of asset. So remember, all expenses till the asset is ready to use. Okay, then second thing that we need is estimated useful life of asset. Okay, estimated useful life of asset. Now it's not very easy to estimate a life of asset. It depends on various factors like what is the nature of asset. If it's, for example, if it's a electronic item, then there is a chance that it will become obsolete after 2-3 years. So all these factors need to be considered while estimating a useful life of an asset. Okay, the third one is estimated scrap value, or also known as residual value. Now what is a scrap value or residual value? See, scrap value or residual value is the amount that may be received, okay, at the end of useful life of asset. Okay, so the sale price or sale value that will be received at the end of useful life of the asset. Say suppose the useful life of asset is 10 years. So by the end of the 10 years we will be selling the asset, right? So whatever amount of that asset will be received at the end of the 10 years, that is the estimated scrap value, or you can also call it as residual value of the asset. Now let's move on to different methods of depreciation. The first method of depreciation that we will be learning is straight line method. Okay, it is also known as original cost method or fixed installment method. So according to this method, an equal amount is written off every year during the working life of an asset, so as to reduce the cost of asset to either nil or residual value at the end of its useful life. Means what? An equal amount of depreciation is charged or it's written off from the cost of asset. Okay, let's take an example. Okay, okay, say there is one plant and machinery. Okay, cost is 1 lakh Okay, residual value or scrap value is 0. Okay, now depreciation charged is 20,000. Equal depreciation is charged for life of an asset. Okay, so see here at the year 1. Okay, so cost is 1 lakh minus depreciation of year 1 is how much? 20,000. Correct. So the written down value, see, this is known as a written down value. Okay, cost minus depreciation. Okay, so balance in the asset account will be 80,000 at the end of 1 year, right? That is at the beginning of year 2. Then depreciation for second year will be again 20,000. Okay, so WDV at the end of year 2, how much? 60,000. Okay, less depreciation for year 3, 20,000. Again WDV at the end of year 3 is how much? 40,000. So less depreciation for year 4, so it's 20,000. Now WDV at the end of year 4 is 20,000. Okay, now let's depreciation for year 5, 20,000. Now WDV at the end of year 5 is how much? Nil. Since its residual value was nil, WDV at the end of year 5 has become nil. Now let's take one more example. Okay, similar example like this. Cost of asset is 1 lakh, residual value is 10,000 and depreciation is 30,000 per year. Okay, so I'll put the example here. So cost of asset is 1 lakh. There are no installation charges, so we'll write that cost of asset is 1 lakh. So it's 1 lakh. Okay, depreciation for year 1 is 30,000, right? So WDV, that is written down value at the end of year 1, becomes 70,000. Depreciation for year 2 is 30,000. Written down value becomes 40,000. Depreciation at the end of year for the year 3 is 30,000. Written down value comes to 10,000. Okay, now see here, 10,000 was a residual value in our example, right? So what happens by charging a depreciation as per straight line method? At the end of the life of asset, you either get your residual value, or if your residual value is nil, the amount or the cost of asset at the end of its life will become nil. Okay, now here I had a simple example wherein we had given the depreciation amount. Now many times depreciation amount or the rate of depreciation is not given. So let's see an example on how to derive a rate of depreciation. Okay. Now here we can see example of a straight line method. Okay, cost of asset including all installation charges, trial run charges is 11 lakh. Scrap value is 1 lakh and life of asset is 5 years. So we need to calculate what is a depreciation charge per year for this asset as per straight line method. So we will first depreciation as per straight line method. I'll call it as SLM. Okay, so what is the formula for this is cost of asset minus scrap value divided by useful life of asset. Okay, so cost of asset is 11 lakh minus scrap value. How much is the scrap value? 1 lakh divided by useful life of the asset, that is 5 years, right? So that is 10 lakh divided by 5 makes it 2 lakh per year. So depreciation that needs to be charged is 2 lakh per year. Now remember, this formula is very logical. See what, as per straight line method, okay, at the end of the life of the asset you must have only residual value or the scrap value. Okay, so you need to write off whatever is a cost minus residual value. You need to write off that entire amount, okay, within the life of the asset. So here what is a scrap cost of the asset minus the scrap value is 10 lakh. Okay, you need to write off this 10 lakh within the 5 years, that is the life of an asset. So per year depreciation is 2 lakh. Now if we want to calculate the rate of depreciation on cost, okay, since this is also known as the original cost method of depreciation, on cost. So 2 lakh per year is a depreciation that we will be charging, divided by what is the cost of asset? 11 lakh. So on 11 lakh 2 lakh depreciation that is charged and into 100, so you get a percentage of depreciation, that is 18.19 percentage on cost of asset. Okay, right? So this is how we calculate the depreciation as per straight line method, or this is also known as fixed installment method, because a fixed amount of depreciation is charged to an asset every year. Okay, now what assumption we are making in this is that a particular asset generates an equal utility during its lifetime. Okay, that is, if an asset, a particular plant and machinery, is capable of producing 40,000 goods per year, then we are assuming here that it will produce 40,000 goods for all 5 years. Okay, so it will provide the same utility for all 5 years. Okay, now let's take one example of depreciation. Pancham brothers acquired a machine on 1/7/1998 at a cost of 14,000 and spent rupees 1,000 on installation. Okay, the firm writes off depreciation at 10% on original cost. Okay, when they say 10%, see here rate of depreciation is given. Okay, on original cost, when it's said as original cost, it's a straight line method. Okay, the books are closed on 31st December every year. On 31st March 2001, the machine is sold for 9,500. Okay, now here you can see, since the rate of depreciation is given, they need not give the scrap value and estimated useful life of asset. That is not required. Okay, so now we'll start calculating depreciation first, and then we'll be giving effect to a ledger account. Now machinery cost of machinery, we'll begin with cost of machinery. Now 14,000 was a cost of machinery and 1,000 was an installation charges. Now as I told you earlier, cost of machinery includes the all cost that is incurred for the particular asset till it is put to use or till the asset is ready for use. Okay, so all installation charges, trial run charges will be added to the cost of machinery. So here the cost of machinery will be 14,000 plus 1,000, that is 15,000. Okay, then we'll calculate depreciation. Less depreciation for year 98. Since the books are closed, okay, at the end of year 98, that is on 31/12/1998, depreciation for year 1998. Now what is the rate of depreciation? Rate of depreciation is 10% on original cost of asset into 10%. Now 10% is every year. Okay, now remember one thing, the machinery is purchased on 1/7/98. Okay, so depreciation will be charged only from 1/7/1998 to 31st December 1998. That is only for 6 months. So into 6 divide by 12. Okay, since 10% is per annum or per year, we need to calculate a proportionate depreciation. So that makes it how much? That makes it 750, right? So balance, okay, balance in the asset account, okay, at the end of 1998, correct? How much is that? 14,250. Okay, then next we have to calculate depreciation for year 99. Now for the year 99, we have used the machinery from 1/1/1999 to 31st December 1999. That is, the machinery is used for the entire year. So depreciation will be 15,000 into 10%. Okay, and we have used it for all the 12 months. So we need not calculate any proportionate depreciation here. So amount is 1,500. Okay, so balance at the end of 99, correct? It's 14,250 minus 1,500, that makes it 12,750. Okay, then depreciation for the year 2000. Okay, okay, now for the year 2000 also, depreciation will be charged for the entire year, since the machine has been there for the entire year. So the depreciation amount will be 15,000 into 10%, that is 1,500. So the balance at the end of 2000 is how much? 12,750 minus 1,500, that makes it 11,250. Okay, now let's move further. Now see, the machinery has been sold on 31st March 2001. That is, in the year 2001, the machinery is sold for how much? 9,500. Okay, so we need to charge the depreciation accordingly. Okay, now see balance at the end of 2000 was 11250. That is, as on 1/1/2001 the balance was 11250. Okay, now machinery is sold on 31st March 2001 for how much? 9500, right? So first we will calculate the depreciation and find out what is a balance as on 31st March 2001. Now see the depreciation for 2001. The machine has been there only for 3 months, that is Jan, Feb and March. So depreciation will be 15,000 into 10% into 3 months divided by 12 months. So that comes to how much? That comes to 375. Okay, so balance at the end of March 2001, that is 31st March 2001. How much is that balance? We'll calculate 11250 minus 375. So balance comes to 10875. Okay, so balance as on 31st March 2001 is 10875. Now we have sold the machinery for how much? 9500. Okay, so sale price is 9500. Now this balance is nothing but a cost of machinery as on 31/3/2001. How much it is? 10875. So it has been sold at a lesser price. So 1375, that is 10875 minus 9500, is a loss on sale of machinery. Okay, now we will prepare one machinery account and depreciation account to understand these transactions. Okay, now I have prepared depreciation account here and machinery account. Now let's post the transactions, okay, directly into ledger account. Okay, now first, Pancham Brothers acquired a machine on 1/7/1998 at a cost of 14,000 and spent rupees 1,000 on installation. Okay, so Pancham Brothers have purchased the machinery. Okay, now let's assume that they have made a payment by check. Okay, if nothing is given, you have to assume that the machinery is purchased and the payment is given by check. So now what will be the entry? Machinery account debit to bank account 15,000. So on the debit side of machinery account, on 1/7/1998, okay, to bank account, right? The amount is how much? 15,000. That is 14,000 is a cost and 1,000 is a installation charges. Okay, now let's go back. Now let's pass a entry for depreciation. Depreciation for year 1998 is 750. So on 31st 12/1998 we will pass a depreciation entry, that is depreciation account debit to machinery account. So let's go here on 31st 31st 1298. Okay, to machinery account. And how much is the depreciation? 750. And the second effect, we'll give it in the machinery account credit side, right? 31 12 98 by depreciation account. And how much is the amount? 750. Okay, now the next transaction is a depreciation transaction for 99, but before that we'll close the books for 98. Okay, so this is 750 credit side total. Okay, so practically what happens is, for all the nominal accounts, right, depreciation account is a nominal account. So for all the nominal account, at the end of year, there whatever is the balance in all the nominal account, it is transferred to profit and loss account, and it's not carried forward. Okay, so I'll put it as by profit and loss account. So instead of balance carried forward and brought forward, you have to transfer it to profit and loss account. So when depreciation is transferred to profit and loss account, the entry will be profit and loss account debit to depreciation, and whatever is the balance will be transferred to profit and loss account. So this is transferred. Right, now machinery account. Machinery account is not a nominal account, it's a real account. So we will calculate the closing balance. Okay, now total of debit side is 15,000, right? So 31/12/98 by balance carry forward 15,000 minus 750, that comes to 14,250. Okay, and here as on 1/1/99 to balance brought forward 14,250. Okay, now the next is depreciation for the year 99. So we'll charge a depreciation entry again for the year 1999, similar to this one, that is on 31st 12/99. We'll charge a entry for depreciation. We'll post the entry, depreciation account debit to machinery account. So to machinery account. Okay, and what is the amount of depreciation for 99? It is 1500. So 1500. Okay, then the next effect in the machinery account on 31st December 99 by depreciation account. How much is the amount? 1500. Okay, now let's close this again. 14,250, 14,250. So by balance carry forward, how much? 14,250 minus 1500, that gives you 12,750. Then as on 1/1/2000 to balance brought forward, how much it is? 12,750. Okay, then depreciation, will transfer it to profit and loss account on 31/12/99 by profit and loss account. So what will be the amount? It will be 1500, right? next entry. Next is a depreciation for year 2000, that is 1500 again. So we'll pass the entry for 2000. So depreciation for the year 2000, 3112 to machinery account. How much it is? 1500. Machinery account again will give the second effect, 3112 2000 by depreciation account 1500. Okay, and we'll close the machinery account and carry forward the balance. So it's 12,750, 12,750. Okay, then balance as on 31/12/2000 by balance, carry forward 12,750 minus 1500, that is 11,250, correct. Then on 1/1/2001 to balance, brought forward 11,250. Okay, and now let's close depreciation. We'll just transfer this depreciation balance to profit and loss account. Okay, 31/12/2000 by profit and loss account 1500. Okay, now the next transaction. Okay, now the machinery has been sold in the year 2001. Okay, so 2001 the machinery has been sold on 31st March. Okay, so till 31st March there is a depreciation of 375. So first we will pass that depreciation entry. Okay, so 31st March, remember the date here is 31st March since the machinery is sold, to machinery account. How much is the amount? 375. Okay, and the second effect of this will be given on the credit side of machinery account 31st March 2001 by depreciation account. Amount is how much? 375, right? Now the machine is being sold for 9,500. So what has happened? Machine has gone out of business, machinery, and we have received a check, okay, of how much? 9,500. Okay, that is we have received a amount in bank. So what will be the entry here for sale of machinery? Machinery account has been credited because machinery is going out. Machinery is a real account. Credit, debit what comes in, credit what goes out, right? So credit machinery account, and bank, debit the receiver, credit the giver, since it's a personal account. So we are debiting the bank account. So entry will be bank account debit to machinery account 9,500. So what we will do is bank account is debited, machinery account is credited. So on the credit side of machinery account we will post the entry of sale, that is on 31/3/2000 by bank account, right? And what is the amount? Amount is how much? 9,500, right? Now what we will do is we will balance this machinery account. Okay, now there is no machinery in this. Okay, we balance this machinery account and we will try to find out what is the closing balance. So 11,250 minus 9,500 minus 375, how much it comes to? 1375. Now if you go to our working sheet, we will come to know that 1375 is a loss on sale of machinery. The same thing, we are getting it as a balance in the machinery account. So this loss we should not be carrying it forward since there is no machinery now. Okay, so on 31/12/2001 we will transfer this to loss on machinery account. Okay, we have to create one nominal account as loss on machinery account, and we have to transfer it to loss on machinery account. See, either you can transfer it on 31/12/2001 or you can also transfer it on 31/3/2001, that is on the date of sale of machinery. Okay, so you can post this entry either on March 2001 or at the end of the year. So entry will be loss on sale of machinery account debit okay, to machinery account, right? So this is how we post the ledger entries in the machinery account and depreciation account. Now one more thing, 31st March 2000 there is some balance lying in depreciation account. So as on 31/12/2001 you'll transfer the balance to profit and loss account. Okay, since balance in all the nominal accounts will be transferred to profit and loss account. Okay, this total comes to 375.